Joining us with this week's Ag Week Market Extra is Randy Martinson. And Randy, we talked about the report, some of the highlights of the USDA report in AgweekTV. Let's talk a little bit more in depth. But first of all, just give us a summarization of the report.
Well, I'd have to say the report was neutral to a little bit friendly on the wheat side. Lower production, better demand. Stocks not coming in as big as expected. Corn, same scenario. Production not hiked as much as expected because of yield. And stocks coming in close. So I'd say it was friendly to the corn side. The bigger thing is we didn't see exports drop a lot in both of those. Soybeans, I'd have to say, was bearish, a little more bearish than anticipated even because of the big drop in exports.
Yeah, 580 million bushel ending stocks figure is a big number. And obviously we're working in some of the tariff situation, but if this continues on for a while, do you anticipate that number is going to get bigger?
I don't expect that it will. I think we could start to uncover a little bit of demand. When you look at it, this 580 is about where we were estimating this crop to be at for an ending stocks, to the beginning of the year because of bigger yield or bigger acres being planted. Acres didn't come into play that way, so we're back up to the high end of, I think, of what the ending stocks estimate could be.
We only saw minor adjustments, though, in corn and soybean yield, and generally the school of thought in the market right now is that with these high crop ratings that we have above a 50 bushel corn or a soybean crop for yield, above a 180 on corn. So August report, do we see a big adjustment there by USDA that pushes those numbers up?
We could, and if the conditions continue, especially now, this high pressure ridge that we've been seeing over the last week is supposed to be dying out. Cooler temperatures are coming in. Perfect for corn pollinating right now because that's right in the heart of the time frame. We could see, and it's likely we will see USDA increase yields in the August report. If weather keeps going as good as it is, I would expect a modest increase, probably half of what they would expect, and then we'd see another one in September.
So the market was pretty bearish going into the reports. Now that we have those out of the way, we still have the trade situation. We still have weather kind of overhanging the market. And so where do we go from here?
Because we've taken so much out of this market, I expected that we would see a little bit of a pushback in it. Some technical buying, at least a little short covering. We've bled so much out of this market right now that there's no farmers are willing to sell, and we need to encourage a little bit of product movement. And the only way you're going to do that is by getting price up. So either basis levels have to start increasing, which we've seen some in some areas, but I think we'll see a little bit of a bounce, give the producer a little bit of an opportunity to make some catch-up sales or maybe put some puts in place. And then we could see if conditions continue to improve, this market drift back in through the fall.
You don't want to be too defensive down at these low prices, though, because if we do get some of these things worked out and we have a relief rally, it could be a pretty big one, couldn't it?
Oh, it could be huge. We've taken $2, a little over $2 out of soybeans, close to 75 cents out of corn, same in wheat. Yeah, if we can see a tariff deal or a demand or trade deal come into play, we could see a 50% retracement. So yeah, I'm not willing to make big sales right now at any time, but putting puts in place just to protect some bottom wouldn't be a bad idea on a rally.
With the report out of the way, does the wheat market now go back and start focusing on those global issues, you think, that we've had?
I think it will. And the nice thing is the USDA is anticipating that we're going to get a little bit more demand because of the trouble in Russia and because of EU. European Union actually lowered production earlier on Thursday's report from them. So I do think we will see a little bit of lightening up and a little more demand coming our direction.
And when we talk about the funds, they are short in just about everything except for just a little bit short in like Chicago wheat. They're actually a little long in Kansas City wheat. Do they keep pushing short in the row crops here, big and bad, or not?
Well, I think they will extend those because we're at a time frame where this crop looks like it's going to be big. So I don't think they're going to give up their short positions yet until we get to the point of the crop being made. Then I think they could start unwinding some of those short positions. But I think for at least the next month, they're going to stay short.
And the cattle market, still within this sideways trading range that we've in. What breaks us out of that, or do we even break out of it?
I think we will break out of it at some point. But yeah, we are very range bound in this market. We set up a trading range and the market's not being able to get out of it. If we can get a big cash trade come into play or some disruption with movement, that'll help support it a little bit. But I think once the market realizes there's not the wall of cattle coming, I think then this market could free itself up and see a little bit of a bounce.
Because demand has been good, especially May exports were like a record, weren't they?
They were, and we continue to see very strong demand domestically as well as internationally with our export market. And it's with China not being part of the market. I mean, they talked about tariffs, but they're not. It's not an issue right now in the beef side. So I do think the demand continues to stay strong, and that's going to help.
And the hogs, just quick, we're very oversold there, but with the tariff situation and big supplies coming, do we see a rebound? Are we close to a bottom?
You know, we might see a dead cat bounce in that market, but it's going to be very limited because you've got your two biggest import markets putting tariffs on us, China and Mexico. We're going to have a lot of product that we're going to have to consume domestically there.
All right. Thanks so much, Randy Martinson, joining us with this week's Ag Week Market Extra.